Hello fellow traders, let's get ready for a wild ride. Today we're going to explore the world of short squeezes and long squeezes, two exciting but risky phenomenon in stock trading. Imagine a roller coaster ride where the price of the stock zooms up and down unexpectedly. That's the world of volatility we're going to explore today. By the end of this video, you'll understand how these events impact stock prices and how to navigate the twists and turns of the stock market. Today we're going to get into squeezes and long squeezes, the price roller coaster by Pajama Trader. When betting backfires. Short sellers betting low. Imagine these bears are investors betting a stock price will go down, the short sellers. Unexpected price surge. Oops, the price shoots up instead. Uh-oh for the bears. Scramble to cover. Short sellers scramble to buy shares to avoid more losses, pushing the price even higher. It's a domino effect. Let's say you're at a racetrack, betting on which horse will win, similar to how investors bet on stocks. A short squeeze is like betting a slow horse will win. But what if that horse starts running unexpectedly fast? That's what happens in a short squeeze. Investors betting on the price to go down, the short sellers, and they're caught off guard by a sudden surge in price. To limit their losses, they rush back to buy the shares, which will cause the price to go even higher, basically a domino effect, with each purchase pushing the price further up. Short squeezes happen. Borrow, sell, and squeeze. Borrowing shares. Short sellers borrow shares from a broker like borrowing a race car. Selling borrowed shares. They sell those shares hoping to buy them back cheaper later, like selling the car before the race. Price goes up, big trouble. If the stock price goes up, they lose money. They need to buy back the shares to return them, like buying the car back after the race but at a higher price. Buying frenzy fuels the squeeze. To cut their losses, short sellers rush back to buy the shares, driving the price even higher. It's a squeeze play. Let's zoom in and see how a short squeeze unfolds. Short sellers are like borrowers in the stock market. They borrow the shares from a broker, essentially borrowing the race car, the stock. Then they sell those borrowed shares, hoping to buy them back at a cheaper price later and return them to the broker, like selling the car before the race and buying it back hopefully at a lower price. But what if the price goes up instead? They lose money. The longer they wait, the more they lose. So they scramble to buy back the shares, which can cause a dramatic increase in demand. The sudden surge in buying by short sellers to cover their positions is what creates the short squeeze. Squeeze, payday or panic. Potential for big profits. For traders who bet on the stock price going up, long positions, a short squeeze can be a golden opportunity. Unpredictable and risky. But short squeezes can also be risky. Prices can shoot up quickly and then fall just as fast. Stay informed and manage risk. Do your research and have a plan before entering the stock market. Short squeezes can be a double-edged sword. For traders who are positioned correctly, long positions, a short squeeze can be a profitable opportunity as the price skyrockets. However, short squeezes can also be risky and unpredictable. Just like a roller coaster ride that can take unexpected turns, the price can surge upwards and then plummet just as quickly. This can lead to significant losses for investors who are caught off guard. The key takeaway is to stay informed about the market, understand the risk involved, and have a plan before entering these kinds of trades. Long squeeze, when the bulls get bucked. Betting high. Imagine these bulls are investors betting a stock price will go up, long positions. Unexpected price dive. Uh-oh, the price plunges unexpectedly. The bulls are feeling the heat. Forced selling. Long holders, feeling further losses, may be forced to sell their shares, accelerating the downward spiral. It's a domino effect in reverse. Short sellers seize the day. Short sellers, anticipating a continued price drop, jump in and buy and profit from the further decline. A long squeeze can be a brutal ride for bullish investors. Imagine you're a long holder, expecting the price to decline. Suddenly, the price takes a steep dive. Fearing further losses, holders might scramble to sell their shares, creating a wave of selling pressure. This can trigger a domino effect, pushing the price even lower. Short sellers, sensing an opportunity, jump in and buy and profit from the decline. How to identify potential short squeezes and long squeezes? Caution advised. Indicators, not guarantees. While predicting short squeezes and long squeezes is a challenge, some indicators might suggest their potential. Remember, these are not guarantees and require careful analysis before making any investment decisions. It's always best to consult with a financial professional before entering these kinds of trades. Here are a few potential indicators to consider. High short interest, short squeeze. A high percentage of company shares being held short could signal a potential short squeeze if the stock price starts to rise unexpectedly. Low float, short squeeze. Stocks with limited number of shares outstanding, low float, can be more susceptible to squeezes as buying pressure can have more significant impact on the price. High Relative Strength Index, RSI, long squeeze. The RSI is a technical indicator that measures the likelihood of an asset being overbought or oversold. A very high RSI, above 70, could indicate a potential long squeeze, suggesting the stock might be due for a correction. Negative news or events, long squeeze. Sudden negative news or events surrounding a company can trigger a wave of selling from long holders, potentially leading to a long squeeze. Increased trading volume, both. A sudden surge in trading volume, especially on negative news, long squeeze, or positive news, short squeeze, can indicate a potential squeeze. While predicting these events is difficult, some indicators can offer clues. Remember, these are not guarantees and require thorough research before making any trades. Consulting with a financial professional is highly recommended. Here's a breakdown of some potential indicators for both short squeezes and long squeezes. Short squeeze indicators. High short interest. This suggests a significant amount of investors are betting the price will go down. If the price starts to rise unexpectedly, these short sellers may be forced to buy back the shares to cover their positions, which can further fuel the upward price movement. Low float. With fewer shares available, buying pressure can have a more significant impact on the price, potentially triggering a short squeeze. Long squeeze indicators. High RSI. This suggests that the price might be overbought, meaning investors are already holding long positions. If the negative news or events emerge, these long holders might panic and sell, leading to a price drop. Negative news or events. Sudden negative news can trigger a wave of selling from long holders, accelerating a long squeeze. And a general indicator for both. Increasing trading volume. A surge in trading volume can indicate a potential squeeze, especially if accompanied by relevant news. Positive for short squeezes, negative for long squeezes. Famous examples of short squeezes and long squeezes. Volkswagen short squeeze in 2008. This is a classic example of a short squeeze. Porsche, an automaker, acquired a large stake in Volkswagen, causing the short squeeze that sent Volkswagen stock price soaring. GameStop short squeeze, 2021 and 2024. Fueled by social media and retail investors, a short squeeze caused GameStop's price to experience a dramatic rise. Technology stock burst bubble in 2000. The dot-com bubble burst in the early 2000s is a prime example of a long squeeze. Many tech stocks had seen rapid price increases leading to very high valuations. When the bubble burst, these stocks experienced significant price declines, potentially due to a long squeeze, as investors rushed to sell overvalued positions. Flash crash in 2010. The May 6, 2010 flash crash is another example of where some analysts point to a possible long squeeze. The Dow Jones Industrial Average experienced a sudden and dramatic drop in a very short period. While the exact cause of the crash remains debated, some theories suggest a long squeeze could have been a contributing factor. A quick pit stop. I've identified some intriguing companies with the potential for significant developments next week, and I'm hoping to share their charts and analysis with you. They are Big Lots, ticker symbol BIG, and Upstart Holdings, ticker symbol UPST. Let's get into their charts. Charting of Big Lots, ticker symbol BIG. I feel that with the high prices, consumers are curbing spending. They'll gravitate to a lot of these discount stores. And yes, Dollar Tree is selling off part of their discount divisions, but I feel that these places are going to grow as curbing on spending keeps going. This has an average volume of 2.6, close to 2.7 million in volume. The buyers came in at a volume of 9.9 million, taking this to the mid-5 area. It sold off with 7.1 million in volume in the low 3 area. This can run to the mid-3s if the volume comes in 2 times the average, but if it sells off, the low 2s is where it could correct. Charting of Upstart, ticker symbol UPST. With Upstart being not only involved in credit card loans, they also have personal loans. Both are being affected by the growing loan defaults, but I can see a bullish and bearish case for this company. The average volume is about 5 million, and the buying came in about 26 million in volume, and that took it to the mid-46 area. The sellers had a volume of 28 million, sending us to the low 20 area. If selling keeps up, this could correct at 21. But if the buyers bring in twice the average volume, this can get back to the mid-40 area. The conclusion of short squeezes and long squeezes. As we wrap up, let's recap the takeaways. Short squeezes and long squeezes are volatile events that can cause stock prices to fluctuate dramatically. They are complex and not always predictable. And thorough research and risk management are crucial before entering any trades, as well as these kinds of trades. If you found value in this video, give it a thumbs up. Share this with other like-minded traders looking to build their trading knowledge of the market. Consider subscribing for more Market Edge videos and alerts to stay informed and ahead of the curve. Remember, responsible investing involves knowledge, planning, and a dose of caution. Thanks for watching.